Hey everybody, it's Friday and it's the weekend, and that means it's normally good for Bitcoin. But a lot of people know I'm very concerned about the macro situation, and that has people concerned. And they should be concerned, but it doesn't mean that your risk assets will go down. I'm not going to break all that down. We're going to go on a bit of a tour of the world. We're going to talk a lot about the debt and how it's really escalating, and not just in the US, but all over the world. We'll actually look at some real estate data, stagflation data, PCE data, the silent thief data, how much of your time, your work product is actually stolen by inflation. I worked out a whole bunch of different scenarios so you can explain to loved ones and how you can fix it, and a ton more. We'll look at S&P 500 CEO compensation, and who's not getting paid, and so much more. And by the way, last time I did 21 charts, Bitcoin price is at $26,000. And by the way, it's not 21 charts, it's actually about 36, because there's simply too much to share. Again, a big part of this will be, forewarned is forearmed. Let's go. I pressed the wrong button and the wrong screen. Yeah, there you go. It's a long day already. Long week. Every week is a long week. From Perth, JC, must be Australian, new to Patreon and loving it. Thank you so much, and a big shout out to everybody on Patreon who make all this possible. And as you know, I believe a picture tells 1,000 words, so I use a lot, and you will see a lot here. First of all, if this does not alarm you, I do not know what will. This is beyond S-curve growth in debt. Let's break it down. Cars Creation, thank you for coming all the way down there in Australia. This is a chart of federal toilet paper. And again, it's US dollar debt, but it's the same or worse all over the world. So you can just stick your little country, map it here. It's the same. So I'm just getting this because this is from Sanjay by courtesy of heritage.org. Now, the US dollar has been backed by absolutely nothing since 1970. It's just printed. But what's crazy is what happened since 2020. March 15th, 2020, the Federal Reserve reduced reserve requirement ratios to 0% effective March 26th. But the key thing about this chart, it took the United States from Debasing 220 years to reach 11 trillion in debt. 220 years. It took less than 4 years to do another 11 trillion. Okay? Like, it's gone beyond vertical now. It's, if you're talking escape velocity, this is not something you want to hang on to. And I always talk about 14% debasement, which is the average debasement for all fiat across the world. You think with this level of printing, your dollar's not going to debase? People argue with me, oh, no, it's not. It's only 3% or 5%, because that's what the government tells me. No, just look at the price of a Big Mac meal over the past 5 or 7 years. It will blow your mind. That's all you need to know. Okay? That's your indicator. Now, what does this mean for us? This is the post-C19 world. For those of you who may remember COVIDians, it's another visualization of debt to GDP and the ratio over the past 2 decades. And of course, we had the pandemic pop in this ratio, which really sent things into high gear in one direction. And does this mean, where do we go from here? Looking at debt to GDP as a driver, and with all the changes going on in the world, we really, really need a GDP grower fast, because the debt is exploding, but the GDP is not keeping pace. And therefore, the ratios are very, very scary. Okay, nobody cares anymore about things like debt to GDP ratio. Nobody cares. Nobody cares about high interest. We'll talk about that too in a second. So we are now back to money printing. Although technically, stealth QE has been happening for a long time with the BTFP program and a lot of other government programs. We'll touch on those as well. But now there's more bills, more money. The red line here is the actual bills as a percentage on the right-hand side. The green is the U.S. Treasury public debt markets, and blue is bills. Again, now everything is going back into high gear. Not a cashless society by no stretch. And what's really crazy is if you look at all the revenue that the economy makes, okay, the this is crazy. The interest payments on debt right now suck up over 1/3 of all revenue, i.e., all taxes. The question that a logical brained person would ask is, why even bother charging taxes? Just print the money, for goodness sake. Anyway, more on this later too. And now that we are in a world where there are some weird things happening, we are in danger of entering a stagflation because there is extreme household debt. The multifamily rate increased following the pandemic and has increased recently as rent growth has slowed. Vacancy rates have increased. The borrowing rates have increased sharply, not just for cars, not just on credit cards, but also for homes. And the rates surged higher again for the last year and a half, and that's really hurting things. Now, we have to watch what's going to happen here. But in terms of delinquency rates, they are going to the moon, okay? And it's just beginning. Same with credit card delinquency rates. Same with car companies that do repos. They repossess cars that have debt on them. They don't have enough people to do all the repossessions. It is scary. It's as if somebody intentionally is trying to torch things. I don't know what the motivation is, but we'll see. And what's also crazy is we know fiat is debasing, but that's also driving things up and to the moon too, like housing. US housing, same with Australian housing markets, same with the Amsterdam market and other parts of the world. US housing is now the most expensive it's ever been in history. Median sales price of a home in the US hit another all-time high of $387,600 in May, measured as a 4-week average. And price increased 4% year over year and exceeded the June 2023 record. And since 2021, median home sale prices have spiked by 17%. There's a whole bunch of reasons for this. One, people can't afford to sell their houses because they're locked into low-rate mortgages. So there's not a lot of supply on the market. And despite the high interest rates, people are still paying a lot for them because there's very little supply available. And people still need a house. So that's a tricky situation. Now, this is crisis time, and this chart here, let me break it down. The basic thing to understand here, you got your bonds, your blues, your bills in red, pink is other, which is non-existent, and the total, okay? It is hard to understate how unprecedented the scale of U.S. fiscal stimulus is right now. Not only is the deficit massive, but we are also in a non-crisis period, and its financing is almost entirely via short-term issuance, which has never been the case before in a non-crisis time. Normally they issue long-term debt, like 10 years or whatever, but now it's all short-term paper at extremely high rates. It's like they don't care. Makes no sense. And what also is going to make things a lot worse too, we have a record 10 trillion. You can't even imagine how much $100 bills that is. $10 trillion maturing over the next 365 days, which will roll into a 5% coupon. That will be another approximately, call it $465 billion in new interest, which will be due on top of everything else, which should be layered on to the deficit that's exploding. It's a perfect storm of badness. Really, really bad. Also, you have hard assets like copper. This is a chart from the Bitcoin layer. Copper is mooning, but really what this means is the dollar is debasing. And it's nicknamed Dr. Copper because of its ability to prescribe the health of the economy. And even though it's going up, we believe it's going up because the dollar is going down. And the unloved metal is telling us that the world is going through a major change. Now, there was decades of stable copper prices. The rise of China sent copper into a secular high a couple of decades ago, and then it's been quiet. But now we're seeing another secular shift, and this is due to the larger regime change. And is it a inflation regime change, a monetary reset, or an electrification of the planet? Maybe all of the above. Either way, not good. And, we've spoke a lot about how the government is actually creating GDP growth because of crazy GDP spending in a stealth way. And this is the revised data showing that the government is basically buying GDP with debt, but only getting 50 cents on the dollar or worse for the amount that they spend. In fact, I've calculated the US government, for every dollar that they spend, they make about 25 cents in return. So when you pay, say, $100,000 in taxes, they are wasting 75,000 of what you give them. And they only make a tiny return on a quarter of it. And that's, again, stunning to believe. That's not just the US government, it's all of them. They don't know how to allocate capital. And just like the labor numbers, and I've done videos on job market data, all government data, in fact, but this is the cyclical component of real GDP, which has been decelerating again after rebounding from a brief recession we had in late 2022. You remember that. I was here with you back then. And the cyclical component is residential investment, business equipment investment, durable goods consumption. They are all in the pooper, everybody. Cyclical component of real GDP was also revised down massively in Q1 from a 2.4% growth rate to 0.6% growth rate. They do the same thing with the numbers of labor. Oh, we created 500,000 jobs. 12 weeks later. Actually, we didn't create any at all. But it's okay because nobody cares what happened to revisions. It doesn't get covered by the press or anything else. All the books are being cooked, ladies and gentlemen. All of them. And it's startling. I mean, I remember that 2.4 came out. I was like, huh? Where'd that come from? Now we know it's only 0.6. So that's the reality. Now, PCE did come out today. What is interesting about this is focus on the yellow line. Okay, this is year over year. That's what we care about. You can see here it is flatlined. It's no longer coming down. It's beginning to flatten, i.e. stalling out. But the trend, question is up or down? I'm not sure. Can the government get to the magical 2% inflation? I don't think so. Not by any stretch. Another view, this is the 6-month chart. I want you to cast your eyes on I really struggle with colors, the yellow one. This is the annualized rate over 6 months. That is critical. Look at what that has done over the last measurement period. It's gone up. That's an alarm bell. That tells you where things are going to go over a year. Inflation is not in control. Despite the fact we could be hitting stagflation, there are certain things out there that simply cannot be controlled, like the price of oil. Now let's go over to Team Europe. We've got a lot of Europeans in the audience here. Thank you all for coming as well. This shows you the euro inflation as of the month of May, just in hot off the press. Right, national reports show a relatively even acceleration across the region's top economies. But I want you to focus on services. 4.1%. Food, alcohol, and tobacco, 2.6%. All items. Energy's down, but it's only a matter of time before that goes up. Imagine when winter comes, that always goes up during winter times. So the question is, the Eurozone was looking for that magical 2%, just like the Fed. They're not achieving it, but they're in such a world of hurt, they're going to have to cut rates anyway. And we'll get to the silent thief afterwards because that's so important. And that's why we're all here. And that's why we're in Bitcoin too. Another view of where most of the heat is in Europe, the 4% zone. All our friends in Spain and Portugal right now, the Netherlands, Greece, all in the world of hurt, as well as France, Germany, you name it. The only places that are actually doing quite well, the UK, I guess, is not. This is not in the Eurozone. That's why they're not on the map. But I'm sure everybody's hurting there too. So anyway, bad. Now, let's switch gears for a second. The reason we look at things like disruption and hard assets is to protect ourselves from the silent thief. And I'll get into that towards the end with some really cool models. But here, just to show you how, as I've always said, the winners take most. Will NVIDIA become the largest company in the world? That's the big question. Right now, these three companies make up nearly $10 trillion in market cap. Coincidentally, it takes the US government about 4 years to create that much debt. Maybe less, actually. And that's only accelerating too. But the three biggest companies in the world, Apple, Microsoft, NVIDIA, 10 trillion market cap. And they're going up because the dollar's going down. Remember that too. Also, they're going up because of the AI revolution. But if you look here, this is just bonkers. I think in the beginning of 2020, NVIDIA had a market cap of about 140 billion. Now it's nearly 3 trillion. That's a 20xer in a very short window of time. And what else? Microsoft about 3.2 trillion. Apple, 3 trillion. Again, ran them all up. 9 trillion. Let's call it 10 trillion because it will be 10 trillion in no time too. And that's why it's so critical. Now let's look at the enormous 8-2 because I always say be in the winning assets. This chart is from Charlie Bolello and he calls them the enormous 8. But cast your eyes on Tesla. There is no company that I know of on the planet or that I've been able to analyze for 35 years that has so many tailwinds. And it's done terrible this year so far. Still up over the last year and a half, but still terrible. Down 29%, Apple down 2%, but the rest of them done really well. NVIDIA up 132%, Netflix and Meta up 34%, etc. So we'll see. Markets can also be irrational. Now, another quick view also from Charlie is the price to sales ratio. Tesla is the second best. You want this ratio to be low. And of course, they do shift expensive items, but some of them are also very high margin, like their mega packs and some of their new vehicles too. So not bad. It'll come back. Let's hope the comp plan is approved and everything will get back to normal. Now, this is also another piece of macro stuff that came out. The US investment grade credit spread, which is the lowest it's ever been, will be dead wrong. So basically, the lowest ever investment grade spread refers to the smallest difference between the yields of investment grade bonds and the yields of risk-free government bonds. And it's the lowest it's ever been in history. And this is a weird problem because there's no way a company like these guys are risk-free. There's always risk. There's always risk in investing. So something funky is going on out there with that. I can't quite put my finger on it, but people are desperate to give money to companies. Anyway, let's look at some other things too. To hammer my point of how the winner takes all, a lot of people think when they invest, if, this company, say Intel, is cheaper than NVIDIA. NVIDIA's already ran. Should I just buy the cheaper one? Well, this is the 3-year return of Intel versus NVIDIA, despite the AI revolution. And yes, Intel is trying to pivot hard, but still, the lion's share of all the gains goes to one company, NVIDIA, while Intel is down 43%. NVIDIA went to the moon and is showing no signs of turning around. So everybody, don't think you're being cute going for second best. Stick with the winners all the time. Now, there is a little bit of caution showing up here on this chart again regarding NVIDIA revenue. You can see that in 2023, revenue is growing at 126%. Now it's only growing at 97%. Go fast forward next year, it may be 70 or 80%. So the revenue growth is slowing, which will impact the stock price growth. So it's one of the reasons I'm currently hedged right now on NVIDIA. That's concerning. Nothing can go up at 100% every year forever. It's just not physically possible. And speaking of Tesla, Elon still not paid in 7 years. Zero comp. The only person in the S&P 500 who gets zero comp as well. I just thought I'd insert that there too, because the CEOs of the median salary of the CEOs of the S&P 500 keeps going up and to the right. So if you work for a Fortune 500 company, S&P 500 company, make sure your salary matches this. And if it doesn't, go to your boss and say, how come I'm not tracking with this chart? Unless, of course, you're the CEO, then you'll be tracking just fine. Anyway, I thought that was because it all goes back to the silent thief, which we'll get to in a second, I promise you. Another quick thing that's happening in the world. This was a cool thing out of China. Nearly, fast approaching 20% of all payments are now handled by WeChat through Tencent Holdings, through a QR code. And this is super interesting. And again, it's for in-person payments made by scanning a QR code for things like online shopping or in-store shopping, etc. And that is bonkers. That shows you how The world is moving not only to a cashless society, but also technology apps are controlling everything. That's not just happening in China with Tencent and the WeChat mobile app, but all payments are moving to crypto. We know that for a fact. So this is PayPal payments are moving to the blockchain. And this is from Marty Party. It's a little bit of Solana news, but the Jose Fernandez da Ponte, the SVP of blockchain, crypto, and digital currencies at PayPal, which is one of the biggest payment providers on the planet, says Solana is perfect fit for its payments. They know the writing's on the wall. They know payments can't be managed using traditional rails anymore. It all has to move to the blockchain to be better, faster, cheaper, and they're making the right steps in the right direction. Now, speaking of China very briefly, their top investment right now is Vietnam. All of their money is going to Vietnam, with second place Singapore, and then Japan, third place Korea, fourth, and Taiwan, fifth. Interesting. They're still investing in Taiwan, where if you read the Western news, you'd think China's about to invade Taiwan. So, weird. Anyway, the world is strange. Speaking of the world, oil and the dollar, U.S. oil exports have been helping the dollar stay strong. And you can see here, per the green line, the strength is, the amount of barrels that are being exported is up and to the right. So the U.S. since 2006 has really turned around the export oil business, which is helping the US dollar stay strong. If this is going to stop, especially with things like BRICS and other stuff happening, that could impact the strength of the dollar, which again would cause other problems too. A weaker dollar means they have to print more of it, so that would even accelerate more money printing, more debasement, which is scary. Now, this brings me to this chart, which is probably the most alarming chart I've put together this year. This is the silent thief. Inspiration for this comes from Cole Walmsley on X, and a shout out to Sanjay as well for sharing with me today. And I decided I'd take his methodology and turn it into a table, but not just use his 2% inflation, but put in 6% and 14% inflation, because it tells a very profound story. Another way to think about the silent thief. So imagine in 2023, you worked for 40 hours. Just cast your eyes on the second column, the magical 2% unicorn inflation, which actually doesn't exist, but we'll pretend it does. So you work 40 hours a week and you make 100,000 a year, and you saved all that 100,000 and you kept it in US dollars, the melting ice cube fiat. At 2% inflation, which is the mandated rate by the Federal Reserve, your money is worth 98,000 in 2024. And after 35 years, it's worth exactly half, 50,000. Okay? So that means the way to think about this is you only worked 20 hours a week in 2023 if you held onto your fiat and didn't invest in hard assets. So you're getting paid less for half. Now, that's what basically inflation says. You've only worked 20 hours, not 40. If we go to 6% inflation, which again is mythical, you can see here, after 35 years, your perceived work is not 40 hours, but it's 5.31. And the value of your $100,000, assuming it's tax-free, is only $13,000. But reality, globally, is more along the lines of 14% inflation. Remember that chart I showed at the very beginning about the debt going vertical? 11 trillion added in 4 years? That's way more than 14%, by the way. Here, you will see if you did work 40 hours, earned 100 grand, after 35 years, that $100,000 is only $1,386, and you've actually worked only half of an hour, or 0.55 of an hour. I'm not sure if that's 32 minutes, or I think it is 32 minutes, but that's crazy. So basically, inflation stole 39 and a half of your work hours in 35 years. So it's a new way to think about how to deal with inflation. And if you do earn fiat, stick it in a hard asset as quickly as you can, or else you're losing it all. All the hours you're working is going away. And Bitcoin fixes this issue. Plonking your money into Bitcoin will help you survive this over time, because no matter what happens, as long as the protocol can keep on running, It's hard. It's deflationary. It's being adopted more and more. More and more money is coming into it. More and more money is being printed. More and more money is going up, which will also float the Bitcoin boat. But holding on to fiat is going to be the kiss of death. That I can guarantee you. That's the quick macro update for today. Sorry if I did disclose some grief tidings, but hey, it's crazy, the money printing right now all over the world. It's like a nuclear arms race to print as much fiat as you can. I wish they'd do something good with it. Why doesn't the government, the age-old question is, why don't they just print money and buy Bitcoin with it? And then that will help their balance sheet. And there are nation states doing this already today. El Salvador for one. Argentina could be second. And when that happens, game theory goes into high gear. And I posted on Patreon last night, the biggest Japanese pension fund is considering Bitcoin seriously this time around. So hopefully that happens too. Big shout out as well to I'm Cold. Thank you for coming. Sean Donnelly, K8 for being here. I will love you and leave you and see you all tomorrow. Have a good day. Bye.